Welcome to this week's Video Insight. I'm Chris Demasi and today I want to talk about Apple. Just over a month ago, I wrote about Apple's share price decline amid a broader sell-off in equity markets, seemingly fueled by worries over the Chinese economy. Despite fantastic quarterly earnings results, which showed Apple iPhone shipments almost doubled in a year in a relatively flat marketplace, the stock price was trading below the level that had started the year. It has done little since then and is now hovering around flat for the calendar year to date. Yet there have been positive developments for the company during the month of September. In the final days of the month, Apple said it had sold more than 13 million iPhone 6s and iPhone 6s Plus devices in their first 3 days on the market. This is 30% more than sales from the iPhone 6 launched last year and a record number for the company, likely boosted by immediate availability in China, where Apple is currently generating 60% of its growth. This performance is outstanding and made for great headlines. Yet a company announcement made earlier in the month is just as, if not more important to the prospects of the business in our minds. When Apple introduced its new line of iPhones around 3 weeks earlier, it also unveiled its new iPhone upgrade program in the US. Starting at $32 per month, Apple customers can purchase a new iPhone with Apple Care service and warranty on an installment plan over 2 years. In addition, after 12 months, the Apple customer can upgrade to the newest release in return for handing in the old phone, and the 20-month installment period resets. There are several benefits for Apple. Firstly, the installment plan bundles the service and warranty offering, effectively forcing customers to take up the additional services. Secondly, the program generates sticky, recurring revenues as customers are highly incentivized to keep paying in order to receive the next new phone. Thirdly, Apple is encouraging a quicker replacement cycle. Fourthly, Apple is able to control the inventory of older iPhone models that are returned and then resell them. And lastly, the financing alternative should widen Apple's market by making the devices more affordable. And even as Apple presses on building impressive value for shareholders, its stock price still represents a trailing free cash flow yield of 16%, excluding the enormous cash balance the company holds. We believe this is an extraordinary bargain for an extraordinary company. That's all for this week's Insight, and please remember to follow us on Facebook and on Twitter.